Okay, welcome. Good morning. It's 10 a.m. on the East Coast. SmartHelping.com here. We are doing the flat fee lending model updates real quick. Let me send out the link to Twitter. The link and test. Twitter. Okay, test sounds good. Let's get that out there. So remember, we're doing a huge update on all the templates. I've been doing it for 6 months. I've done about, I don't know, I'm in the 40s, I think, with all the startup models. I've done about 40 upgrades integrating a three-statement model. Every single template is different, so I have to do them all, unique. So I've been doing that on stream. The model I'm doing this week is the flat fee lending model, which is part of the industry-specific category. And this one right here. So this is what I'm upgrading. Basically a model that allows you to figure out if you originate loans to people and you charge a flat fee instead of a regular interest rate. Um, and potentially you can source your funding through other debt and make a margin on the interest rate essentially versus your flat fee. And then the loan terms are obviously going to be a big impact on that as well. So this is a really interesting model. I've had a lot of clients use this and want this, and I've actually got one that's requesting a three-statement model on this one. And since I hadn't done it yet, I figured I'll put this up to the top of the line. I've got a couple more I want to do before I begin doing brand new templates. Uh, I want to do the e-commerce one, uh, vending machine, and possibly the bike shop one. And then I'll get into brand new builds from scratch. Remember, you can check out smarthelping.com for all the different financial models and templates I've got uh, for all kinds of different businesses and categories. You can buy everything in bulk here for $9.99 on the whole site, or you can shop by category. There's over 100 unique templates here, all professional grade, built based on what I've been paid to build in the past, and then I've built them all into just usable templates based on the knowledge I've learned. Alrighty, well, let's jump in here. So where we're at today is the hardest day of these integrations, and that's getting the financial statements actually working. And this is going to be a little bit tricky with the, uh, you know, how we do the balance sheet, but we'll get into it. So first of all, let's get our revenue, which is not ATM fees. That's going to be called, uh, well, we got a couple revenue sources actually. Let's look here. So we have fee earned from each loan type. Oh, actually, I guess that is only fee. Let me look at the loan configuration. So there's just a flat fee. There's no origination fees. There's no interest rate. There's just a flat fee paid on the principal borrowed. Okay, so there's just one stream. So we go here, we go fee revenues. Make sure the annuals, okay, that's linked to it, perfect. And then that'll just be equal to our monthly detail, total fees earned here. Let me just double check. Yep, that's just equal to that. So we drag this over for 60 months. And there's the total fees earned. Remember, we're stopping the model on November 23rd instead of the last month of the last year, just to make sure the logic is following that. Okay, variable costs. So we do have some here. On this, I did, so cost of goods sold based on, uh, so this is like if you have software that you're using to provide the loan servicing, and I did, so the logic on the cost of goods sold, let's see here, is just, we've got amount per loan per month, and then a hard coded amount if you just want to say, okay, these are, X dollars per month, and it starts in X month here. You can define that over the 10-year period. So these are just arbitrary numbers, but let's go over. So I want to take these, I'm going to call this, let's see, really, I mean, I think they are I'd rather call this a variable cost than cost of goods sold anyway, so this is fine. And we're going to just have one type here called, well, let's see, do we want to break it up? We could do cost per active loan and then general cost of goods sold. So cost per active loan is going to be equal to sum of this, and then that one is going to be the sum of these. Now you'll see as we propagate this, there'll be checks to make sure the financial statements here and the total cash flow match what's going on in the monthly and annual detail, as well as the distributions and executive summary and all of that. So there's going to be sanity checks that make sure that's accurate. Okay, what happened? Why is this going to 0? Oh, I'll just put this through the whole 10 years just so there's some numbers in here. Perfect. Okay, so then we have our just administrative and general costs, which are going to be all of these. Sales rep, so we've got sales and marketing, general and administrative, and R&D. So let's put that here. So we have general administrative. We'll put them in order that they appear. So sales and marketing, general and administrative, research, development, and startup costs. Now we link those in. So sales and marketing, that, G&A, R&D. So those are, and then we have startup costs here. Let's look at this. So yeah, I only put in costs for, it looks like, percentage here, and these are all blank, but if we put in like a 5, just so you can see, now there's costs coming in here. Yeah, the G&A we just have, so last person to use this template, or last time I used it, they wanted to zero out all of the OPEX and just have essentially the activity of the loan show up in the financial model. And I figured that's a decent way to start, but I'll put in a couple of fillers here just so you can see the amounts. Yeah, basically they just had defaults, and that was it. Okay, interest. So here, okay, this is the first part that this gets tricky. So the interest we're paying out, oop, the interest we're paying out as the interest expense that's tax deductible would be this here. Where, where is it? Oh wait. Total debt service paid month after draw. So right here. And that's going to be based on a rolling credit facility. Now, if you opt to not have a credit facility to fund your loans, then that will be 0. And you can do that by putting a no in here. So we're not assuming any leverage is used to originate the loans. In that case, this is all 0. Otherwise, what's going to happen if you hit yes here is you'll take out draw to fund these loans, and then any proceeds in revenue earned will go directly first to repay that. So you can see the debt balance here is adjusting over time. Oh wait, no, we're assuming that just goes into perpetuity and you continue to pay the rate, and then at the end month you can pay that off. Now you can manually define this draw and repaid here. So see how it happens here. You can manually put in when you repay this, and it'll flow through the cash flow. Like if I were to put, okay, I've got a balance of 1.2 million. I've made some positive cash flows from my lending activities, and now I want to put, let's say we want to pay off, 500,000 of it here. So you can do that, and you can see the balance goes down to 710, debt repayment goes to 500. Now let me see, 710. Oh, did I remove? So I removed the logic. Hold on, let's double check this just while we're on this, because it's an important part. Let me get the original, because you definitely want the option to be able to repay that, you know, loan as soon as you have the cash, so you don't have to keep paying this interest rate. Or if you think you can reinvest the cash you're getting and earn more than this APR by just keep continuing to loan it out, then obviously it makes sense to just keep this debt facility going and just keep reinvesting into the flat fee loans that you're offering people. So that's like the base default assumption of the model. But I'm seeing here if I've built in the cash flow in case you did want to. I see. So I set that against the terminal value. So the final cash flow, yeah, that's what I thought. So this final cash flow here does look at that, but it's assuming, so if we were to, let's see, I must have just left the bottom part. Yep. So let's bring this logic back in here because we're going to need this. So 2 down from this. Whoops. We need to be in column D or E. So this is the calculation. Terminal value. We'll have to update this. And what you can see here is we're taking the EBITDA, which is just your fee revenues, less defaults, and then you're subtracting the interest you have to pay. You're adding any debt proceeds, reducing any debt repayment, adding any terminal value, reducing any debt disbursements, adding any repayments, and that's your total cash flow. And so, and then these fees are already included in EBITDA as well as the defaults. So that's why I put in EBITDA right here. So that's how we figure out the cash flow that's actually available. So that is fine. Whoops. Cash flow. And yeah, so if you wanted to, you could repay some here. You see that cash flow, you get a negative amount here, and you can see the running balance. We'll take that into account. In theory, you only had 8,000 at this point, so you're probably not repaying that there, but you could put in any extra cash flow. So if I wanted to, I could say 18,379. Now my cash flow is 0 for the period I've reduced the debt. Here I could go 18,038, and keep using that positive cash flow to repay this loan. Or you could model in your loan configurations to try to make it so that this is closer to 0 on the cash flow, which means you're just continually reinvesting everything into new loans. And you see this cash flow doesn't really go up that much because we are continuing to originate. Um, so the closer this is to 0, the more you're not having a cash drag. But you might want to have some cash in reserve for whatever reasons. If it is a business, not just like a personal investment in P2P lender, you may want to have some cash on hand. Okay, and then yeah, this is negative because we haven't configured the new terminal value spots. So this is all fine. This works good. And I like to go through this so I really understand what I'm looking at when I go to model this in the through statement model. So the interest here makes sense. This is got to be updated, so we don't need all these CapEx items. You really don't need much here. I mean, it's just basically defaulted if you have a building that you bought to have offices in, or and in that case, you might have computer equipment, things you want to depreciate. So that's why this is here. Um, so we've got here, let's put some dates on this. All right. You can select the date of each CapEx purchase, the useful life, the cost basis that will all flow through to the model and affect CapEx as well as, cash flow as well as the income statement. Okay, so this seems to be working just fine with our logic. Let's see here. So this total should equal 1,202,000. Okay, so it's pulling everything good. Then we have taxes here. The first 2 rows are just for the exit. Now here we have a 0 terminal value because I have to configure it still with the new format, and then you've got taxable income. Yeah, we'll have to update this. Okay, let me look at the annual. I'll just set this equal to the income statement. Okay. And that should 0 out. Let's hide this. Okay, we are missing some things. 889,000. So what might that be? For EBITDA, we've got 438. So that matches, so it's something down here. Might not be worth it to even match this up. Oh yeah. So we don't even have values coming in here yet. All right. Well, and I know it's because of the terminal value. So let's look at this. So terminal value, is really just going to be based on this net asset value, which is essentially going to be your loans receivable and cash. So let's see, monthly detail 70. What do I have in 70? Oh, total outstanding loan amount. So, okay. So in this case, our end month is November 30th, so we should have 1.33 in there. So we switch this over one. So there's the terminal value based on a multiple, and then possible seller fees, and you've got the net terminal value. So this number is what should be flowing through terminal value D9. So I'm trying to see how I fit this into here. So what I'll do is say loans receivable at exit, and then we put if this equals yes, then give me this total net, or this net terminal value, otherwise 0. Multiple of receivables, which is this. Okay, then we have this amount here, and then everything else should be flowing fine from that. Okay, we have amounts coming in there. Let's put 90, I'll keep that at 100 actually. Well, no, let's put 95, and on the CapEx, let's say we've got a building in here. Now, some of these, let's say this is bought later in the forecast. And again, my assumptions are arbitrary. I'm just making sure this logic works when you put in numbers. Okay. Right now I'm just assigning what amount of the terminal value is going to be applied to fixed assets versus just essentially goodwill. Okay, this looks good. So if we look at the income statement, we have some numbers in here. So this terminal value basically drives the whole model. Let me look at the monthly. Okay, so that's coming in fine. Good. So now, one second, let me get a bite here. Okay. Uh, Let me see why this is 0. So 6. Let's take out the if error and see what's going on here. So there's a value error. What's CapEx J82 looking like? So that's fine. Taxes. So, right, these are probably in the wrong spot. Yeah, they're 27, 28. So let's update that. Uh, so 27 and 28. There we go. And there's no taxes here. We're operating at a net loss until some of that depreciation ends. Now there is some taxes. And you've got your exit tax here, or exit proceeds. And this will apply properly the tax between gain on fixed assets versus essentially goodwill. If you don't want to show taxes, you can always zero that out in the global control tab right here. Okay, so this is flowing. This is good. This now matches, so that's great. Balance sheet. So this is going to be some fun here. Let's hide all these extra fixed asset spots. So the balance sheet, we have to figure out basically two main things are the credit facility and the loans receivable. So those will be new. And then cash flow, we're gonna have all kinds of stuff happening here. So I think I actually want to do the cash flow first. So let's see, customer receipts, this is fine. OpEx looks good. Let's see, 1931. Yep, okay, so those are good. Interest is fine. And taxes looks like it's going through. So, but we have to add here. So from operating activities, let's see. We want to add, so for financing, so borrowing of not necessarily long-term debt. I'm just going to put debt here because the credit facility you might only use it for less than 1 year potentially. So this is going to be, and there's no like traditional debt schedule. It's just there's a credit facility, you may or may not use it, and that's it. All other funding from like if you're trying to fund other startup costs and operational burn from, you know, non-lending activities or not directly lending, like paying a CEO and all that stuff. You could have other costs, so that those are going to have to come from equity investors. Let's see. Where, oh, cash flow. So borrowing of debt, I believe we can just hit equals monthly detail. Debt proceeds, this. And this will have to match the aggregate value of the balance sheet. So here's what we borrowed as the credit facility. Okay. Repayments we've made to that facility would then be this, repaid here, which at this time is only going to be happening on the end period. I'll probably have to do some some logic here. If I hit no on not including terminal value, that means that no debt is going to, or no loan receivables are going to be sold. In that case, these should both zero out. So this, now terminal value, C44. So what I want to say here is if this equals no, then zero. Otherwise, just do the calc. And I also want to say, so now that's zeroed out, and I'm trying to go to the base, the earliest calculation that exists. And this one I want to go if this equals no, then zero, no matter what. Otherwise, you can do the other calc for repayment. Alrighty. So if we select no, that just goes into perpetuity. Zeroes out here. Okay. So we've got the facility kind of accounted for, principal repayments. Now we also have loan activity we have to do on here somewhere. So technically that's the main operations. So what I would put here is this is probably where things get really tricky on how this is accounted for, but at least we can put the line item here so you can see it. And it nets out to the right effect for the monthly period cash flow. So we can just put um, funds dispersed for loans, funds received from loan repayment. So lending money out is here. It'll be negative value, and then they pay that back. Collected here. So 314, 315. And this will vary if you put collection of the loan evenly spaced over the term, or if you do it all at the end, it will affect this. So right now by month 7 it's normalized, so you're continually dispersing 440 and receiving 440 back as the loan terms end. Now that would change if you change these loan terms. You can also change the terms over each year. You can change the rate, the weighted average loan amount, the start month, all that. And then let's see, so this should just be summing all of this up. Okay, so this is good. So now we have to make the balance sheet match what's happening from the income statement, cash flow statement. Now the balance sheet needs to match, and it does not right now. I can guarantee that. So liabilities, I'm not going to put non-current liabilities. I'm just going to put credit facility. And also let's make sure this matches. We got to insert a row. Now inserting a row here probably means we need to also fix any formulas referencing the cash flow statement. Now let's just make sure this matches for now. 1.825. Okay, that looks good. this is pulling cash flow 31. Okay, good. So that updated. All right. So credit facility. Now the balance of the credit facility is going to always equal at the end of the month. It would be the proceeds minus, or let's say it'd be the draw minus any repaid amount. And then the same thing for the next period, plus the balance at the beginning. So balance sheets essentially, you can just think of it as like a running balance. Now, let's put this terminal value back to yes. Okay, good. So this zeroed out. That's good to see. So we have the credit facility. Now the loans receivable, we also need it in here. So I guess if the term's less than 12 months, it technically could be a current asset. If the terms are greater than 12 months, it'd be a longer term asset. What I think we can do here is just put in an extra row in 97 saying loans receivable. And loans receivable balance will be this total here. Where's my total? Total loan amount outstanding. So that, now you can see how this is going to get real tricky to make sure we're all balanced because there's a lot of formulas and logic and math going on here. So there's my receivables balance, and then this needs to add that to it. Now, this amount probably, let's see, total outstanding loans. So this amount I want to zero out if we are, because we're essentially going to collect that with the terminal value. So if the date is greater than end month, then 0. Now a trick here I just thought of is what happens if the terminal value, which is just based on this balance and a multiple of this, if it's greater than that, let's say it's 1.2x you get for the receivables, or less than that, 0.8x, the cash flow, the balance sheet is going to zero that out here, and the cash flow will add the multiple, but the difference of that has to flow somewhere as, I wonder if that's called, so I don't know. I'm assuming that would be a gain on, like a, almost like a gain on asset. And so that would have to be reported on the income statement as a gain or loss or nothing, and therefore taxed at, let's see, so this is sale of business. I believe it would flow into here. So what we need to do, so there's the asset. If this was, let's say, 1.2, so we'll put gain loss on receivables sold. We'll say it's the total net after fees minus the base. And so if it were, so this is essentially going to flow through. We'll put a note here. It's going to flow through to row 123 on income statement. because that's going to affect retained earnings in that on the month that um, the exit happens. If we are including terminal value, then we have to show the difference, if any, from the value of the receivables and what we're actually getting. And so it could be negative, it could be positive, but that amount has to be accounted for, otherwise we will not balance, because the balance sheet or the cash flow is looking at 1.596, but the balance sheet's looking at 1.33. So the difference has to be a gain or loss, which will then make the net or retained earnings match in that month of exit. So what I want to do here on this one is also just simply at the end of this, so terminal is greater than 0, some capex less than 0. Okay, plus this. Now, if we go over here, this should go up by 200 some. Perfect. So there'll be taxes there as well. But now we have that extra cash flow accounted for. Okay, so that's good. Dang, we're still, well, this is probably going to be, actually, I don't know. We'll see. So we've got cash, non-current assets, loans receivable, credit facility. Let's put in some startup costs here. Oh, we had 90,000. Okay, so we've got cash flow and 320. Let's put other cash flow items. So 320 and down to 326. Oh wait, we added. So cash flow. So I don't need this right now, which was just adding. Yeah, that was just adding that. So cash flow in 328. Let's just clear all this out. This is in 310. This is 318. So why is that different? Okay, let's play this game. So we got, okay, matches, matches. Scroll down, matches, matches, matches. Okay, we're still matching. Ah, okay, so the monthly has these reps head counts and the annual does not. Oh wait, hold on. Hide. Well, do we still, so debt service is 294. This must be where we're out. So we have more spaces for these. Okay, that's okay, as long as I know what it's coming from. So other cash flow items. So this is not accounting for taxes, capex. We do have terminal value in here and debt repayment. Taxes, capex, what else? Anything else? This, and that. That's on there. We have all of that. Okay, I believe that's it. So if we put on these cumulative cash flow. Startup costs. So cash flow, and let's put in taxes. Oh no, don't start doing this again. Please don't. Looks like you're froze. Okay. So yeah, sometimes Excel will freeze. It's been doing this for the past couple months. All right. When I go to reference another tab, so I need 19 and 14. Oh wait, switch these. Do we have any taxes? Wait, did I go to the right one? Taxes. We do. So 14. It starts in month 61. Okay, good. Um, so cash flow, capex, taxes, startup costs. So my total cash flow is going to be equal to this plus here, that. Um, cumulative cash flow, it's just that, sum of this. And this will be determined on our minimum equity needed beyond the credit facility. Now, so, oh, hold on. Oh, shoot. We got to add in that other stuff. So this is here. let's redo this. So if we start at, well, first of all, let's get rid of this huge blank spot. Okay. And we'll deal with this after. Okay, so cash flow should be EBITDA plus cash drawn minus anything repaid minus this debt service. We've already got EBITDA or flat fees and defaults in there. I think that's it. And then we go plus CapEx plus taxes because these are coming through as negatives, and then startup costs. Now if we drag this over, so essentially this is let's see, there's a lot going on here. So EBITDA, add this, subtract this. Now, did we double count the interest? Let's look up here. No, earnings before interest, so this is not in here. So this is where we're just trying to match up these cash flows correctly. Because this has to balance, because the balance sheet is going to be based on this minimum equity needed, which is going to flow through to the owner's equity based on equity contributions. Okay, so add this, subtract here, grab that. So then all this is already accounted for. Oh, we also need to add this terminal value. So all the 313 is in this case would be, wait, we don't have draw. We have draw, we don't have disbursements. So let's subtract out disbursements. So we're drawing, we're dispersing, and then we're also receiving back here. So add that. Okay, so now, right, so now we're just basically paying the CapEx here, and then any interest. So if you add, so essentially we're just saying the cost is, or the equity is going to be CapEx plus interest. Oh, 42. And then what's the difference between these two? Defaults, 648. Oh, there's some OpEx in here. 537. Yeah, it's all of that. So if I were to zero out the OpEx, then it would just be the cash requirement is CapEx plus any interest on the credit facility. And then this assumes you're basically reinvesting any cash that you have back into more loans, dispersing more loans. Okay, so this makes sense. Let's drag this over. Now, why are we naked? Oh. So we have to also do plus terminal value minus this debt repayment. Hold on. Minus this plus that. So 806. Why is this so? Oh, double counting. We're double counting. So this is already. We don't need this because we're counting for the repayment here, but we also have to do the extra proceeds there. Okay, there we go. Now I believe we've hit every item. So this is the minimum equity needed, which is essentially the sum of CapEx plus any interest. So 286. So if we go over here, this is got to be 286. 486. Now what's going on here with the cap table? Ah, yeah, so this is a different position now. So it's this number. So there's our equity. Yeah, this will be fun. Once I start playing with these levers, once we have it all balanced, it's really gonna see if we'll probably have to update some of the formulas. Okay, great. Well, we balanced the balance sheet for now, so that's great. Let's update the labels on the annual here. So we added loans receivable. Which will equal, let's just put it, we'll probably have to do logic around this, but shoot. For now, we can just make this equal loans receivable here if the month matches the end of the month of the year. No, E-date. It's comma 11. So match the last month of the year with this. Add that to here. Still out. Uh, 770. What is that? Well, so at the end of the year, we're saying we're at 159,159, and on the annual, so something's out on the liabilities or equity. So credit facility should be 1.2 million. What do we have here? We don't have that number. Okay, yeah, it's a different calculation now. So let's just pull from the monthly balance sheet, and then we want row 103. And then what are we matching here? C5. Oh, it's just, okay. All right, and then, yeah, it's just, we're going to have to figure out this, but for now it's okay. So we're still out on the exit. Loans receivable, in theory, this should be 0. In November, because we're exiting in November. So let's see, 70. Can I make that 0? This is where things always get tricky is on the terminal month with these loan things. So, all right. So in theory, we're repaying this. I need to keep it here to figure out the amount, but on the balance sheet, it needs to be zeroed out. So if this, if and this equals the end month and this equals the yes, then pull the amount, then zero. Otherwise, you can pull the amount. Oh, forgot to close the bracket. So end that. Okay, now we can drag this over. Now we should see that zero out in the end month. Okay, so that's good. However, what else do we got here? We're out by 824,000. It's probably something to do with the cash flow. There's so much going on here to try to keep straight. Uh, so do we have this terminal value hitting the cash flow statement? Well, wait. Let's zero out the building for now. Just zero this out. So 195,915, which is this. $1,596,000. Okay, so we're missing some stuff here. Terminal value. Loans receivable, I've got 1,596. No, it should be this, and then you multiply it by that. C40. So this should be C40. Okay, now 1,596. 1,596. Okay. And then this is 1,663 because there's a difference here. Okay, this is still out. Luckily, these are out the same amount, so that's good. So I'm saying the total exit is 1,596,000. The receivables were only 1.3. So the difference there goes to gain. However, so we're going to have to do this minus selling fees. And then we're saying that's applied to extra income. This is applied to CapEx. So am I double counting the gain then, I guess? Okay, so if that's our terminal value, that was our basis, but we're already assigning this between these two. So technically, some of this, if this is all extraordinary income or goodwill, this is all CapEx related. I don't think we can do that with this situation. It's different. Here's what we have to do, I think. We have to put of the 1.33, the only thing that would come into extraordinary income would really just be, well, nothing really. You're just selling an asset. You're not even putting anything in a goodwill. So this is 0. Hard coded to 0. So all this is applied. However, let's see here. How are we going to do this? Oh my goodness, this is a tough one. This is a tough one. I'm trying to say you get this much cash, but we have to recognize this gain. But we're already doing logic to try to recognize gains over here. Oh man, you know what? So we're saying all of this in theory is now going over to here. All 1596 is right here. We need to define the percentage that is going to here. Okay, I think I got it. Here we can define percentage as fixed assets remaining goes as a gain on sale of receivables. There's probably some crazy accounting that goes on when you're trying to value the receivables and calculate the gain, but I'm just trying to do some basic calculations here. So if I were to say 75% goes to fixed assets, so let's switch these. This is going to equal this times this. This will equal this minus this. So here we've got 399, we got 1,197,000 going to the fixed assets, which is this, to calculate those gains. And then we have 399 recognized as the portion that's going to receivables. Although shouldn't this be hard coded? This should be hard coded as whatever this is. And then this is just going to be the difference. So that's always going to be whatever the value is over here, because that always has to match. Okay, so we got 1596 coming in. I believe this is right now. Um, let's look at this. No, I think this is doubling it. We have 1,663,000. So sale of business is 266. That and the rest is here. Okay, so now we don't have to actually re-add that into here. So this plus C45 we don't need. Oh wait, now it's 1,397. Hold on, what the heck? It should be 1,330. What's the difference here? What in the world? 67,200. So is this looking at here? J81? No, J80. Which is nothing. Hold on, what? Oh dear. So if there is an exit, then sum capex J3 to J80. So since zero, oh right, sum that. So J is just the variance between the sale, which is the total, and the book value, which is after depreciation. Now, more than likely, these will probably be zero, and this will all just 100% be going to gain on the receivable. But I'm trying to model it based on that not being the case if potentially you have fixed assets that are like equipment or something at the end of the sale. So, and this is what I mean by having to think through this rather than using the template logic. It gets really hard. Come on. All right. So the cash flow is getting it correct. The cash flow has the correct number. The income statement is trying to say what part of that is actually taxable. So it's going to be a little bit less, but I think the number is right. So 1,397. We can drag this over. I believe we got it here. So 13, yeah. So 131 is this. There's the 131, that total, that makes sense. The 266 is that, so that's fine. And this is actually now called gain on gain loss on receivable sales. So that difference is there. And now the difference between here and terminal value, this 198,800, is just the difference between, is basically this. Yep, 198.8. So this book value. So that should zero out in the balance sheet, I think. Okay. Oh, there's other things we probably got an issue here on. Okay. Well, let's see here. So we are out. So what's happening on this end month? We've got assets we're saying are just equal to the cash. We zero this out. This should be the gain. Accumulated depreciation. And oh, do we need to hold on? What's this? This variance 239. Um, so in theory, we're selling all of these fixed assets for 1202. We've depreciated the first half, but we've got the second half here. Oh yeah, this is gonna be pretty much a complete nightmare. All right, so what is actually happening? Because this is where we figure out how that balances out with the gain and the difference and all that. So this goes away. We get the 1.3 back into here, plus the gain. The retained earnings should account for the gain. Which is just the difference between the actual amount and the amount here. Oh man. This is paid back. That's going to hit the cash flow statement. So you got positive here. Operations. Hmm. Oh wait, this is, hold on. Sale depreciable assets. That should be pulling 1,330,000. The difference is going to the versus net assets versus terminal value. Oh man. I knew this was going to be a complete nightmare to do completely. All right. Technically, this is a gain only. This is gain or loss, and this is gain or loss on, so this is too much. Or do we just go, I mean, it's the same number. It's the same number. There's 1.596 million coming in. It doesn't matter if it's part of this or this. In reality, you're just selling the receivables. right, so say 25% is going to fixed assets. Oh, hold on. If this equals that, okay, so this doesn't even matter. This is actually a fill calc. Okay. So this is the gain on sale. This is the amount to capex. And now as far as taxes go, only the gain hits the income statement. The cost basis, which would be the difference between this and whatever, in this, is this total, 198.8, which in theory should be what's left, what's basically being zeroed out in the accumulated depreciation. I think I'm stuck. I think I'm stuck. I've done, hundreds of these things. I think I'm stuck. No comments from chat. I'm not surprised. This is freaking puzzle beyond puzzles. Um, oh, this is crazy. All right, well, I think this calls for drastic measures. We are taking out CapEx. No longer existing, deleting it. And it's not a big deal because the core business of a flat fee lender, oh shoot, yeah, I mean you're not going to be your core business is not based on your fixed assets of equipment and all that stuff. You might have it, you could throw it into startup costs, it just won't have depreciation. But we're removing this, so it's causing too many issues on the balance sheet. I don't think it's even possible. Let's clear this out. Uh, so now we don't need any of this. All we say is value of loans at exit. So we have 1.596 coming in. We do have gain loss on sale. I mean, 90% of this model is the value is figuring out how you scale the loans and what your cash flow looks like, not the exit and the tax effects on the fixed assets. That's like a 1% value of the model, so I'm not that worried about this not being in there. Okay, so now, let's see. So let's just clear that out. For here, and here obviously remove the reference error. Remove 123. Oh, we still got an error. What's going on here? depreciation. So yeah, we're not having, so this we can clear out. Now, if you wanted to, you could add depreciation and manually do it, and that's fine, or manually do these, but a lot of the calculations here are just based on activities of the actual business. Let's see. Wait, which one did I keep? Right, so gain loss. So this is going to be equal to D8. Okay. So that, yeah, so we can clear this out, delete all of this. 44. 37, 41, 44. This is 41. Okay, I think we got it. 41, 44, 46. Okay. And a couple reference errors here. That's fine. Move that. We don't need this. Actually, we don't need F error either. All right. So, at least this is making sense here. Oh, let's update this calc as well. Oop. Okay, so this looks good. Yeah, let's go back to here. Let's fix this. Okay, so we have no longer, let's clear this out. None of this. This is no longer relevant. Actually, we can just delete everything except for loans receivable. So that's in 15. Okay. Cash flow. So CapEx no longer on here. This is just going to be sale of loans receivable, which is going to be only if and this equals terminal month and this equals yes, then pull this total value here, otherwise 0. All right, so what happened? If and this ah didn't lock the global controls. Lock this here. Lock that. Okay, so we got our value there. This is fine. Yep, just some if. Okay, and then are we matched up on the cash flow 4,443? 4, 4, yep, okay, so we're good here. Balance sheet. Probably have some reference errors. Oh, assets. So if you're greater than, let's go to the monthly actually first. All right. Drag this through. So we have cash and loans receivable as our assets. Credit facility is fine. This is fine. We're balanced through to the last period. Let's update this. Okay. So this goes away, that goes away. So the question is, we're out by 2 million now, but it should be a lot easier to track down what happened. Also, let's see the monthly detail. Okay. There's no more capex. I haven't even done the annual, so that's fine for now. And our goal here is to balance this balance sheet, and then that's the last thing we really have to do. Then we can start testing. So I'm up by 2.42. What could that be? So let's look at the cash flow. 2.8. 444. I mean, so that's the amount. That's definitely the cash balance. We're selling the receivables. That number's hitting cash, the total amount we're getting. We're paying down the payables right here. So that's so so this is flowing up into cash. This is going to zero. That's fine. Retained earnings. So I normally, let's see if the 51. Okay, well, our assets are, I believe, correct or more likely to be correct because this adds up to all the cash happenings. 4,443. Although, how are we getting to that number? Because we're only getting 1.8 here. hold on. If we add our monthly detail cash plus cap table, it's almost matches. Actually, so this, it looks like our assets are way too high. Or we haven't accounted for everything correctly. So let's see. Yeah, this is a negative. Okay, well that's the first thing. This is a negative value. That's probably our that's probably it. Yeah, awesome. We balance. Whew. I've been doing this for a while, man, and this is the most stuck I've been. But looks like we got there. Holy cow. Oh my goodness. Okay, that's really good. Let's fill this out for the annual detail real quick. Wait, how is this so different? 281, 240. Oh, I keep forgetting. We have all those other this is not on the annual detail at all. Okay, so one below this. It's fine. Let's just redo this. So that's here. Startup cost is just always going to be here, so that's fine. And then I believe no, 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 no. All right, so we got to do this again. That's good. That service. So these are all in the right spot, I believe. EBIT is in 217 though, and here it's in it's in 217, but I'm way farther down. So 217 is the very first one. I'm in 176. Okay, there we go. Now, this will be a very easy check. We just make sure, okay, does this amount equal the monthly ending cash flow? It does not, so we're out. And we know what that is. 1596 is our exit proceed right there. And I'm assuming, well, okay, let's just redo this formula just so I can make sure. So EBITDA plus draw proceeds minus anything repaid minus any debt service plus proceeds from terminal value. This is selling the proceeds. Minus disbursements plus payments collected. Oh, and account for that and taxes. Okay, perfect. So we're zeroed out on this. That's good. Awesome. I'm sure our distribution's got to be updated. So that's going to be, well, before I even get into that, let's just make sure. So the balance sheet's good. That's good. If we update this, let's make sure just nothing gets weird. Okay, that's still working. If we put no, okay, that's just zero on the credit facility, but it's still working. Okay. Let's put no on the terminal value. Okay, so here's our first issue. So if we put no on terminal value, this needs to zero out. I believe. Well, no, it's saying that the facility is still there. Oh, but this is, hold on, when's our end month? November still. Okay, so technically nothing exists here. So let's simply say if this month is greater than the end month, then zero. Although, hold on, this is always the part. I feel like this is like the least value added. Oh my goodness, but the most difficult. Let's lock C6. So that balances now. However, what happens if we hit yes on terminal value? Okay, good. So that still works. Now the balance sheet we know does not work if this is no. Oh wait, it does now. Wait, no, it does not. So it's out by probably the month, by something that's going on in the last month, I'm assuming. Let's see, 283, 491, so it's matching the cash balance. Total assets at 2503. Here, total assets are 283. Liabilities are zero. Well, on the end month, it's actually 2182, 193. Okay. Retained earnings 127, 152. Total equity is 320, 691. All right, so what am I out here? 37.2. So let's go over to it. Cash balance is fine. Good. Loans receivable is zero. Here, loans receivable is 2.2. So that's an issue. This loans receivable should not be zero. Okay, so we have to do a more complicated formula. If the year of this equals year of the end month, so there's my logical test, then I want to index wait, what am I currently indexing? Matching and yeah, so we don't want to do that. Only on, so if it's on the terminal year, we do index here, match that with the balance sheet monthly amount, comma zero. And actually, we want to say we don't want to index 5, we want to index 15. Okay, now if we drag this over, okay, so now we have the amount in there. Balance sheet amount is 220. Okay, what's the next? So 2503, so that matches. Then we have credit facility 2182. Here it's 0, so again, same thing. So same thing, except for now we're matching row 21. So I just want to do this same calculation. Except for I'm going to do it here. And I want to match 21, not 15. Perfect. Okay. So we're good there. Let's go back. So if we hit yes here, let's make sure it works. Okay. Okay, good. Let's put this end year here. And the last month of the last year. Okay, that's working. Let's put no. Awesome. Let's try one more permutation. If we go 1 year earlier and end it, looks good. Okay, and then let's go into that year. Oh wait, let's put yes for the terminal value and check. Okay, good. And then let's put midway into that year and check. Okay, that looks good. All right. So that was fun. Um, Gee, mini Christmas. So income statement looks good. Annual, the balance sheet's fine. Oh yeah, so is this solving for 0? It is, doesn't look like it. So now we have to match up the balance sheet with the annual or monthly detail. And to get that to work, the check is to make sure this cash balance goes to 0. Right now it's going to 1,242, so there's something off here. So something that's happening in the cash flow statement is not happening in the monthly detail or vice versa. So let's try to figure that out. So net change in cash, if we go period 1 in the cash flow statement, it's this. If we look here, it would actually be including this amount plus this amount and then plus equity. Okay, so, and those equal. Now, next month, we see 7,379. All right, so let's see where, okay, here, we have a false here, so taxes. Uh, so here's the issue. This is starting in L of the cash flow statement. Oh no, come on Excel, stop freezing on me. So taxes should be starting in D14. So that looks like what our error. So this would be then E. And then, oh, it's still false. Let's drag this all the way over. Okay. Oh, it's barely off though, so let's do this minus this. It could just be a rounding thing with Excel. Yeah, okay, we're good. So now we should see a 0 balance on the balance sheet, a 0 cash balance at some point. Perfect, there it is. So there's our check. So I know that's the right number. Oh, thank goodness. Man, what a great model. Just so difficult to get these balance sheets all lined up and matching correctly. Alrighty. So distributions, we just take the total cash flow happening in month row 285. Same with this. Oh, wait. And that's based on row 2. Change both of these. There we have that. Now equity. So remaining equity to use would be total equity plus cash flow for the first period 0, which is just startup costs. And then this is just equal to here. And I believe, let me just check this real quick. Yeah, so these are both negative. Now, this total cash balance here, 476,324, should match the annual, which it does. Okay, good. Let's do a check there. So sum of all of these cash flows minus annual detail, that should always be 0. All right. The cap table should be pulling that same data. It looks like it is 30.2, 8.2. Oh wait, what happened here? Ah, so investor funds would be here. Owner funds are now in this position. Okay, 8.2, 30.2, so those match. Now, cash flow per month, we'll have to update that. So it's in a new row now. $285. Okay. Now what happened to this? Oh, I've just got all those zeroed out, so that's fine. Okay. Looks like everything else is working. Now, executive summary. So there's definitely going to be some updates to this. So no capex. Taxes are now happening here. Debt service. Let's just make sure that's in the right spot. Debt service coverage, that's an important one. Startup costs, we do have that in here. proceeds from exit. So really, that's just going to be cash flow statement of that. Oh, come on, Excel, stop freezing on me. It is 21. Okay, so this is all good up to here. Loan proceeds. That's going to be, where do we put that? Borrowing of debt right here. Loan repayment. Let's see, annual detail 229. Okay, so that's still matching up. That's fine. Loan disbursement. So this looks good. $1,004,942. Is that the right number? No, it's not. Also, what happened to this? Equity required by the project. Equity required by the investor and by the owner. Now, what are we missing here? Okay, there's all kinds of stuff. So I want to go annual detail and just check the period amounts. All right, so we're off on all of these except for year one. And it's not a whole bunch, but what is that variance? Oh, let's just, I bet you I know. All right, EBITDA, probably the sign changes. So plus this, minus this, plus that, plus, plus, minus, minus, plus. There we go. Okay, so 414, 403. Oh, we're still out. Well, let's put in the calc or the check. So this minus this cash flow balance should be 0. All right, so 61,000. What in the world is that? Let's make sure EBITDA matches, I guess, first. So 4,432,000. That's, yep. Debt service 4135. Well, let's just look at that matches. Okay. Wait, what? Wait, this matches everything. What did I do? Okay, check this minus this. Okay, it matches. I think I just did the annual numbers to the or the periodic instead of the cumulative. Okay, good. So we're checked on that. We're checked here, checked here, checked here. So now you can go in and fill in all your different assumptions for the loans, the terms, the types, the timing, the costs, all that in all these assumption tabs. This is actually no longer an assumption tab. It's all references. Um, so the big change was we just removed CapEx. It was just too difficult to try to combine that with also the gain or loss on the loan proceeds if there was a sale that was higher or lower than a cost basis. But that can now be accounted for. So this is the best I believe you can do for a template purposes. Really cool logic here for the loan configuration that will flow through. Let's do some sanity checks. So income statement I-65, that's good. Balance sheets is 59. Oh, it should be 40. So none of the base logic changed in this model from what I had. All I've done is add income statement, balance sheet, and cash flow statement. And I've updated the global control a little bit, but I mean, I haven't really, it's just formatted differently. Annual check against monthly. So that would be this check here. Oh, we got an error on this one. So this is checking the balance sheet cash flow here. So index this if our end month matches this. So that's that, and then we want to subtract that from what our annual detail is saying, and then we want to subtract that from equity, and it should be 0. Perfect. Executive summary to annual detail and distributions. It's that one, and then this N76 to R. It's just checking all of this here. That looks good. This needs to go out to W though. Okay. Wow, what an upgrade that was. I'm glad it's only Tuesday and I was able to finish it. I was pretty worried about an hour in, but we got there. Uh, let's do some sanity checks again. Make sure these all zero out with changing of the date stuff. Okay, good. We just want to see zeros. Last check. All right. So this looks good. You go in here, configure your strategy, your launch year, end month, if you're going to include the terminal value. Uh, Now this is based on if yes, the end month will include an exit value based on a multiple of final month loans receivable. All right. And other than that, I think we are all set on this. I'll update the index tab and do an overview video tomorrow. Happy to get this one done. Again, I had a customer looking for this. They wanted a 3-statement model, so now it's done. Oh man, it was just tough. It was a tough one. All right, well, don't forget, check out smarthelping.com for more. This model I just upgraded is part of the industry-specific bundles right here, flat fee lending. Also, check out all the models, financial models tab at the top for forecasting, financial forecasting tools, and just different templates. I've got all sorts of stuff for all different businesses. real estate, SaaS, um, joint venture distribution waterfalls, accounting, and finance tools for inventory, accounts receivable and payable tracking, budget versus actual, cost of goods sold, FIFO valuation, all kinds of sorts of things in here. So check it out. Also, you can buy every single thing I've ever built on smarthelping.com for $9.99 if you want the bulk order. Alrighty, I will see you guys. So again, what I'm planning on doing is an overview video tomorrow. I'm probably not going to do another upgrade till next week. I want to do the vending machine model and the e-commerce model. Once those three statement models are done, I'm going to get back into brand new startup models from scratch. So that means not just the integration of the three statement model, but building like assumptions like you see here, like this loan configuration, like building new things for new businesses. So I'm excited